and they all had the same intellect we had. They were in the same general climate. They had lots of natural resources.
And life is so much more fun this way, too. I mean, who wants to spend their life trying to change?
I can give you an argument, but I can't give you an understanding. Cost of capital discussions that I've never heard an intelligent one. That does not mean we approve of every buyback at all, though. I mean, we've seen... No. I think some people just buy it to keep the stock up.
Welcome, fellow investors and enthusiasts, to a captivating exploration of one of the most legendary partnerships in the world of finance, the dynamic duo of Warren Buffett and Charlie Munger. In this video, we delve into the timeless lessons gleaned from their extraordinary collaboration at Berkshire Hathaway. Beyond the billions and market prowess, Buffett and Munger's partnership unveils a rich tapestry of principles that transcend the realm of investing, offering a roadmap for success in business, leadership, and life. Join us as we unravel the wisdom, unravel the strategies, and uncover the profound insights that have made this partnership a beacon for investors around the globe. Get ready for a journey through the decades as we uncover the secrets behind the success of two of the most iconic figures in financial history. Welcome to Warren Buffett and Charlie Munger, Lessons from their partnership. Warren Buffett and Charlie Munger were two legendary figures in the world of investing and business. Their partnership at Berkshire Hathaway was a model of success in investing, business, and leadership. Their collaboration produced remarkable results and provided a wealth of lessons for investors, entrepreneurs, and enthusiasts alike over several decades. One of the pillars of their success was their unwavering commitment to the long term. Buffett and Munger were known for their patient capital, which entailed holding on to investments for an extended period, often measured in years or even decades. This long-term focus allowed them to navigate market fluctuations and capitalize on the compounding effect, a key driver of their wealth creation. The value investing principle was central to their investment philosophy.
Your children are going to live better than you live, and your grandchildren are going to live better than your children live. And we do not focus.
Buffett and Munger looked for companies that were undervalued in comparison to their intrinsic value. This method entailed a thorough examination of a company's fundamentals, such as its financial health, competitive positioning, and growth prospects. They aimed to capitalize on potential market mispricing and generate superior returns over time by identifying businesses with a significant gap between market price and intrinsic value. This dedication to value investing has been a cornerstone of their success, establishing them as two of the most successful investors in history. They emphasized the importance of staying within one's circle of competence when it came to value investing. This concept entailed concentrating on industries and businesses that one was well versed in. They reduced the risk of making uninformed decisions and increased the likelihood of successful investments by sticking to their circle of competence. This methodical approach to investing was consistent with the notion that a thorough understanding of the businesses in which one invested provided a competitive advantage and improved one's ability to make informed decisions. Another guiding principle in Buffett and Munger's investment strategy was quality over quantity. Rather than investing widely, they concentrated on a few carefully selected businesses. This focused approach enabled more in-depth analysis and greater conviction in their investment decisions. They prioritized the potential for long-term success over the illusion of safety that diversification might provide by investing in a small number of high-quality businesses. The ethical dimension of business was an unavoidable component of their strategy.
$500, I paid her hundreds of millions of dollars for her business.
They emphasized the value of honesty in business dealings and actively sought out companies with trustworthy management teams. This dedication to ethical business practices was consistent with their belief that long-term success was built on trust and that companies with high ethical standards were more likely to thrive in the long run. They embodied a rational and disciplined approach to decision-making in addition to their investment principles. They advocated for marking investment decisions based on logic and analysis rather than reacting emotionally to market fluctuations. This emphasis on logic and discipline was critical to their ability to navigate the complexities of financial markets and make sound investment decisions. Buffett and Munger's success was built on constant learning and adaptability. Despite their enormous accomplishments, they maintained a humble demeanor and were willing to adapt to changing market conditions. The ability to adapt to changing times, update investment strategies, and remain open to new ideas was critical to their longevity and long-term success in the volatile world of finance. The Buffett-Munger partnership was also built on open communication. The two's open and candid discussions, which were frequently displayed at Berkshire Hathaway's annual meetings, demonstrated the importance of effective communication in a successful partnership. This transparency not only promoted a healthy working relationship, but also allowed for the exchange of different perspectives and the constructive debate of investment ideas.
Look about you, and then, take it back in time 200 years, and it wasn't there.
They coined the term economic moats to describe a company's competitive advantage. They looked for companies that had strong and sustainable competitive positions that shielded them from competition. Companies with economic moats were more likely to withstand competitive pressures and demonstrate resilience over time, whether through brand strength, cost advantages, network effects, or other factors. This emphasis on economic moats reflected their emphasis on investing in businesses with long-term viability. Despite their enormous wealth, Buffett and Munger were known for leading frugal lives. This seemingly contradictory characteristic stemmed from their commitment to long-term wealth creation rather than extravagant spending. Their habits reflected their approach to investing, a focus on the essentials, avoiding unnecessary risks, and a commitment to long-term wealth accumulation. Beyond the principles outlined, the Buffett-Munger partnership also reflected a broader philosophy that extended to their views on market efficiency, risk management, and the importance of a durable corporate culture. Buffett and Munger expressed skepticism about the efficient market hypothesis, which posited that all relevant information was already reflected in stock prices. While they acknowledged the efficiency of large markets, they believed that inefficiencies persisted, providing opportunities for astute investors to uncover undervalued assets. This skepticism aligned with their emphasis on diligent research and their conviction that markets were not always rational in the short term. Risk management was a fundamental aspect of their investment strategy. Rather than focusing solely on potential returns, Buffett and Munger paid careful attention to the downside risk of an investment. They prioritized the preservation of capital, recognizing that avoiding significant losses was crucial for long-term success. This risk-averse mindset was reflected in their preference for businesses with predictable and stable earnings, as well as their aversion to investments with uncertain or speculative outcomes. The significance of corporate culture was another dimension emphasized by Buffett and Munger. They recognized that the culture of a company, shaped by its leadership, played a pivotal role in its long-term success. Investing in business with strong and ethical management teams was not only a strategic decision, but also a reflection of their belief that a positive corporate culture contributed to a sustained performance and shareholder value. Berkshire Hathaway itself served as a unique case study in corporate culture. The decentralized structure of the conglomerate allowed the individual companies within its portfolio to maintain their distinctive cultures while benefiting from the overarching principles set by Buffett and Munger. This decentralized approach enabled them to build a conglomerate with a diverse range of businesses, from insurance and energy to consumer goods, while preserving the autonomy and identity of each subsidiary. Furthermore, the Buffett-Munger partnership placed a premium on simplicity. In an era of complex financial instruments and sophisticated investment strategies, they advocated for a straightforward and understandable approach. This simplicity not only aligned with their preference for businesses with clear and transparent operations, but also reflected their belief that complexity could often lead to confusion and increased risk. The philanthropic endeavors of Buffett, particularly his commitment to the Giving Pledge, further illustrated their values. Buffett and Munger were proponents of responsible wealth distribution, with a focus on using their wealth to address societal issues. This commitment to giving back underscored the broader impact of their success and their recognition of the role that wealth could play in promoting positive change. The longevity of the Buffett-Munger partnership not only shaped the investment landscape, but also left an indelible mark on business literature. Their annual letters to shareholders, speeches at Berkshire Hathaway annual meetings, and various interviews provided a treasure trove of insights and wisdom. These communications served as a guide for investors, offering not just financial advice, but also lessons in leadership, ethics, and the enduring qualities that contributed to sustained success. In conclusion, the partnership between Warren Buffett and Charlie Munger transcended the realm of investing. It embodied a set of principles and values that extended to business, leadership, and life. Their legacy was not only in the wealth they created, but in the principles they espoused, the businesses they nurtured, and the philanthropy they championed. As investors and leaders navigated the complexities of an ever-changing world, the Buffett-Munger partnership continued to serve as a timeless source of inspiration and guidance. Charlie Munger died on November the 28th of 2023 at the age of 99. As we conclude this deep dive into the profound lessons from Warren Buffett and Charlie Munger's extraordinary partnership, we invite you to reflect on the timeless principles that have shaped their success. What resonated with you the most? Are you inspired by their long-term perspective, their commitment to value investing, or perhaps their emphasis on ethical business practices? Share your thoughts in the comments below. We'd love to hear your insights. If you found value in this exploration, don't forget to hit the like button and subscribe for more enriching content, and ring the notification bell to stay updated on our upcoming videos. As you continue on your investment journey, remember that the lessons from Buffett and Munger offer not just financial wisdom, but a roadmap for a successful and fulfilling life. Thank you for joining us in unraveling this tapestry of their partnership, and until next time, happy investing.